Welcome to the deep dive. Today, we're pulling back the curtain on something that, well, it might seem a bit abstract. The really intricate link between how a country manages its currency and the stability of its entire banking system.
Yeah, it sounds technical, but it's fascinating.
It really is.
Yeah.
And understanding it is, frankly, key to grasping what makes economies tick, or sometimes, falter pretty dramatically. Our mission today is to unpack a really influential World Bank policy research paper. It's from back in November 2000, titled Banking Crises and Exchange Rate Regimes. Is There a Link?
Yes, by Delmas and Martinez-Piria. A very timely piece back then.
Exactly. They looked at 2 decades of data covering both developed and developing countries. So we're going to try and pull out the core insights, maybe uncover some surprising findings, and help you get quickly up to speed on a critical global issue.
Absolutely. And you have to remember the context. This research came out right after those major financial crises hit Asia, Brazil, Russia.
The late 90s.
Precisely.
Yeah.
And that really reignited the whole debate about exchange rate choices.
Oh.
What's great about this paper is how it shifted the focus. It wasn't just about, say, inflation or growth.
Visual macro stuff.
Exactly.
Right.
It looked squarely at financial stability and the specific connection to banking crises.
Yeah.
It's digging into not just what happens, but, why it matters so much for the real economy, for ordinary people.
Okay, let's dive straight into that core question then. Does a country's choice, whether its currency is fixed against another or if it floats freely, does that choice actually affect how likely it is to suffer a banking crisis? It feels like a huge question for policymakers.
It is, and the empirical results in the paper are, well, they're quite compelling and robust, too.
What did they find?
Basically, adopting a fixed exchange rate significantly reduces the likelihood of a banking crisis.
Reduces it. Okay.
Yes, reduces it. And this finding is particularly strong when you look at developing countries. They really tested this rigorously, across different models using different definitions of what constitutes a crisis.
So different ways of measuring it.
Right. They looked at the actual exchange rate behavior, the de facto policy, not just what the government said its policy was.
That's important. Actions versus words.
Crucial. And they even tried to control for the possibility that maybe countries pick fixed rates because their banks are already weak. But even accounting for that, the result holds up. Fixed rates seem to lower the odds of a crisis.
So the data points towards fixed rates acting as some kind of shield. This is where it gets really interesting for me. How does that work? What are the mechanisms? Why would fixing your currency make a banking crisis less likely, especially in developing economies?
Okay, the paper explores several powerful arguments.
Yeah.
You can almost think of it like maybe a triple defense mechanism.
Triple defense. Okay, I like that.
First, it acts as a kind of policy disciplinarian.
Disciplinarian. How so?
Well, committing to a currency pegs tying your currency's value to, say, the U.S. dollar. It imposes pretty strict limits on what policymakers can do. It discourages erratic monetary or fiscal policies.
So it ties their hands a bit in a good way.
In a way, yes. It minimizes those self-inflicted domestic shocks that could otherwise destabilize the banks.
Right.
Like built-in guardrails.
Okay, guardrails. What's a second defense?
Second, it's a credibility booster. Fixed rates are often seen, rightly or wrongly, as more transparent and credible by international markets. Perception matters.
Hugely. This credibility can insulate a country from, market jitters, contagion spreading from elsewhere, rumors, stuff that can trigger instability if markets think your policy is unpredictable.
Okay, discipline, credibility. What's a third?
The third is that it acts as a powerful debt deflector. This is absolutely crucial, especially for economies with what's called liability dollarization.
Liability dollarization, right.
Yeah.
You mentioned that earlier. What exactly is it?
It's basically when businesses, and sometimes even individuals in a country, borrow heavily in a foreign currency, often U.S. dollars. This is very common in developing countries.
Okay, so they owe money in dollars, but earn in their local currency. Exactly.
Yeah.
Now, imagine the local currency suddenly devalues sharply under a flexible regime.
Their debt burden explodes overnight.
Precisely. It skyrockets in local currency terms. That can lead to widespread bankruptcies, corporate defaults, and boom, a banking crisis.
Yeah.
Because the banks hold those loans. A fixed exchange rate prevents that sudden, massive, nominal devaluation shock.
Got it. So it avoids that specific trigger.
Yes. As the economist Calvo put it back in '99, liability dollarized economies are just highly vulnerable to devaluation. And just to zero in on developing countries specifically, fixed rates help address some unique vulnerabilities they often face.
Like what?
Things like a general lack of policy credibility to start with, maybe limited access to international capital, that high liability dollarization we just talked about, and also a significant pass-through from exchange rate changes to inflation.
Pass through. Meaning?
Meaning, if the currency weakens, the price of imported goods goes up almost immediately, hitting consumers hard and fast. These factors, as Calvo and Reinhardt argued, often make flexible rates less suitable, leading authorities to actively resist big currency swings, what they famously called a fear of floating.
Fear of floating. Okay, so fixed rates seem to offer this strong defense, almost like a magic bullet for stability in these contexts. But hang on, what about the classic arguments for flexible rates? Shouldn't they act as a shock absorber? Allow the economy to adjust?
That's the textbook argument, absolutely. Flexible rates should allow for a more stabilizing monetary policy. The idea is the exchange rate takes some of the hit from external shocks, reducing the pressure on domestic interest rates, maybe boosting exports if the currency weakens.
Protecting growth, basically.
That's the theory. However, this paper and other research highlight some pretty big caveats, especially for developing countries.
Such as?
Well, for one, the empirical evidence often suggests monetary policy in flexible regimes in developing countries is actually pro-cyclical.
Pro-cyclical, meaning it makes booms bigger and busts deeper.
Exactly. It amplifies the cycle instead of smoothing it out. Kind of the opposite of what you'd want.
That's not ideal.
Not at all.
Yeah.
Second, because of that lack of credibility and the fear of floating we mentioned, many developing countries with officially flexible rates often, well, they refrain from using their exchange rate flexibility when big shocks hit. They intervene heavily to stabilize the rate anyway.
So the shock absorber isn't actually allowed to absorb the shock.
Pretty much. And third, modern financial crises often involve really complex shocks, maybe coming through the capital account, hitting both demand and money supply at the same time. This makes the simple textbook case for floating rates as an easy shock absorber much more questionable in the real world.
Okay, so the evidence suggests fixed rates lower the probability of a crisis. That seems like a clear win. But is there a catch? There usually is, right? What happens if, despite having a fixed rate, a crisis still happens? Are there downsides then?
Yes. This is absolutely crucial, and it highlights a major trade-off, a really significant one for you to consider.
Okay, what is it?
While these fixed regimes seem to reduce the likelihood of a crisis starting, the research indicates that the real economic costs measured in terms of lost output, lost growth for the economy are actually higher for countries with the more rigid fixed exchange rate arrangements if a crisis does occur.
Wow, okay, so fewer crises, but potentially much more painful ones when they do hit.
Exactly. It's kind of a double-edged sword. You reduce the frequency, but you might increase the severity in terms of economic fallout.
That's a huge distinction. So beyond that higher economic cost, are there other inherent risks or maybe hidden drawbacks to fixed regimes that the paper points out? Things that make the system fragile in other ways?
Yes, definitely. Two other major risks stand out from the research. The first one is moral hazard.
Moral hazard. Okay, how does that play out here?
Well, a strong commitment to a fixed exchange rate can accidentally create what you might call implicit guarantees for people borrowing in foreign currency.
Implicit guarantees, meaning the government will bail them out.
Or at least that the government will do everything possible to defend the peg, meaning the exchange rate won't move against them. So private sector players, banks, companies might think, why bother hedging our foreign currency loans? The government's got our back on the exchange rate.
So they take on more risk than they should.
Precisely. They take on greater unhedged foreign currency exposure, gambling that the government will maintain the peg, or maybe even bail them out if things go really wrong. The paper actually finds empirical evidence for this, a statistically significant link, suggesting that for a given level of unhedged debt, the risk of crisis is higher under pegged regimes.
Because of that risky behavior they enabled. Okay, that makes sense. What's the second drawback?
The second major one is related to the lender of last resort.
The central bank's role in a panic.
Exactly. Under a truly fixed exchange rate, the central bank's ability to step in and inject emergency liquidity into the banking system during a panic is severely limited.
Why is that?
Because printing lots of local currency to bail out banks expanding domestic credit rapidly could completely undermine market confidence in the fixed exchange rate peg itself. People might fear the currency will have to be devalued.
So the central bank faces a terrible choice. Save the banks or save the peg.
That's the dilemma. Defend the peg or ensure financial stability. This lack of a lender of last resort, or at least a constrained one, can itself encourage bank runs and financial panics because depositors know the central bank's hands are tied.
That's a very tight spot. But just playing devil's advocate, couldn't a central bank under a flexible regime also get into trouble if it prints too much money bailing out banks? Wouldn't that cause problems too?
That's an excellent point, and yes, the paper acknowledges that. The mere existence of a powerful lender of last resort, even with flexible rates, could also encourage bankers to take excessive risks, knowing there's a safety net. That's another form of moral hazard.
Right.
And if the market starts anticipating huge bailouts, massive injections of cash, well, that could lead to a very rapid expansion of the money supply and trigger a major destabilizing depreciation of the currency anyway. They saw exactly that happen in Venezuela back in '94.
So it seems like managing banking risks and central bank responses is incredibly tricky, regardless of the exchange rate regime.
It really is. It's a complex balancing act of incentives, risks, and potential consequences, no matter which path you choose.
Okay, so stepping back a bit from just the exchange rate regime, what other factors did Domas and Martinez-Pariah find consistently pop up as drivers of banking crises? What else makes a country vulnerable, according to their data?
Right, the regime isn't the only thing that matters, of course. The study confirms several other key determinants that influence crisis likelihood, painting a broader picture for you.
Good. What are they?
Well, first, GDP per capita. Countries that are richer, with higher GDP per capita, tend to have a lower probability of facing a banking crisis.
That makes intuitive sense. Maybe better institutions, stronger regulation.
Likely correlated with that, yes. Better legal systems, better contract enforcement. It suggests a foundational element of stability.
Okay, what else?
Credit growth. This is a classic one. Rapid booms in domestic credit lending significantly raise the likelihood of a banking crisis. This idea of a lending boom preceding a bust is very well established.
And so, too much lending too fast is a red flag.
Definitely. Then there are capital inflows. Large net inflows of foreign capital, especially when they're channeled through the domestic banking system, also increase the likelihood of crises.
So money pouring in can be risky too.
It can, if not managed well. Interestingly, the paper notes these inflows seem slightly less damaging under fixed regimes compared to flexible ones.
Yeah.
Maybe because fixed regimes have more developed financial systems already, or perhaps slower real exchange rate appreciation makes it easier to adjust. It's a complex interaction.
Okay. Anything else?
Yes, the M2 to reserves ratio.
M2.
Yeah.
That's broad money supply, right? Like cash and deposits.
Exactly.
Yeah.
A higher ratio of this broad money supply, M2, compared to the central bank's international reserves, increases a country's vulnerability, especially under fixed rates.
Why specifically under fixed rates?
It reflects that fear. We talked about the fear among people holding domestic currency deposits that the central bank might not actually have enough foreign currency reserves to convert their money if there's a run on the banks or the currency.
Got it. The piggy bank looks too small compared to potential withdrawals.
A good way to put it. And finally, back to unhedged foreign liabilities. As we discussed before, the higher the ratio of foreign currency debts to foreign currency assets held by banks, meaning big currency mismatches, the more likely a crisis becomes. And again, this effect seems more pronounced under fixed regimes because of that moral hazard issue.
Okay, so quite a few factors beyond just the exchange rate contribute to the risk. Now, we talked about the likelihood of a crisis and the real economic cost, the hit to growth. What about other aspects, like how long does a crisis typically last? Or what's the fiscal cost to the government, the direct taxpayer bill for cleaning up the mess? Does the exchange rate regime influence those?
That's another really interesting part of the study. They looked into those dimensions too, and the findings add more nuance. Let's take the fiscal cost first, the direct cleanup bill for the government.
Okay.
The exchange rate policy, whether fixed or flexible, does not seem to affect this fiscal cost significantly.
Really? So fixing or floating doesn't change how much the government has to pay out?
Apparently not, according to their analysis. Instead, the size of the fiscal cost seems mainly driven by other things, like how high real interest rates were before the crisis, how large bank credit was relative to GDP.
So pre-existing conditions.
Exactly. And, crucially, by specific choices made during the crisis management, like using regulatory forbearance.
Regulatory forbearance, letting troubled banks keep operating without strictly enforcing rules.
Yes. That can delay the inevitable and often makes the final bill much higher.
Okay, so fiscal cost isn't tied to the regime. What about the duration of the crisis? How long the pain lasts?
Similar story there. The degree of exchange rate flexibility or the specific regime type does not appear to have a statistically significant impact on how long banking crises drag on.
So fixing your currency doesn't make the crisis shorter if it happens.
Doesn't seem to. What really matters for how long a crisis lasts, according to the study, is the size of the credit boom prior to the crises.
Ah, back to the lending boom.
Yes.
Yeah.
The bigger and more unsustainable the credit boom that preceded the crisis, the longer and more painful the crisis tends to be afterwards. So while fixed rates might make a crisis less likely, they don't seem to offer a shortcut through the recovery phase.
Wow. Okay, this has been a really fascinating dive into, as you said, some serious economic plumbing. So let's try to pull this all together. What are the big takeaways here, especially for you, the listener, trying to make sense of these complex policy choices?
Well, I think it really boils down to understanding the fundamental trade-offs between credibility and flexibility that policymakers face. There's no single right answer.
It's always trade-offs in economics, isn't it?
Pretty much. So first, the paper strongly suggests that fixed exchange rate regimes can play a significant role in promoting financial stability, especially by imposing discipline and boosting policy credibility.
The guardrails and the booster effect.
Exactly. And for countries that maybe lack really strong independent institutions to support, say, an independent central bank focused solely on inflation, a fixed exchange rate might actually be a sensible second-best strategy for monetary policy. It provides an external anchor.
A substitute for strong domestic institutions, in a sense.
Perhaps. Second, the paper really challenges the conventional wisdom about flexible rates for developing countries. It suggests they often act less like shock absorbers and more like a distributing transmitter of financial shocks, meaning they can actually increase volatility in domestic asset prices, potentially disrupting productive investment and financial stability itself. That fear of floating has real consequences.
So the flexibility isn't always helpful. It can even be harmful.
In certain contexts, yes. Third, there's that interesting side point about incentives for prudence. It's possible, as Aishan Green suggested, that the very fragility of a fixed peg forces bank supervisors and managers to be more careful, knowing that excessive credit creation could bring the whole system down.
An interesting, maybe counterintuitive benefit.
It is. And finally, we need to properly understand why the real costs are higher under fixed regimes when a crisis does hit.
Right, the double-edged sword.
It could be due to things like bigger, lending-based consumption booms that reverse more sharply. Or perhaps it's just that fundamental inconsistency. We talked about the difficulty of injecting the liquidity needed to fight a banking panic while simultaneously defending the exchange rate peg. The system is just less flexible under stress.
So putting it all together, it's definitely not a simple case of saying fixed is good and flexible is bad or vice versa. It really depends on the country's specific situation, its vulnerabilities, its institutions.
Precisely. The optimal choice is highly contingent. It depends on the country, the time period, the specific shocks it faces. However, the evidence from this paper strongly suggests that for many developing countries, the stability offered by fixed exchange rates can be incredibly valuable, especially given those common features like high liability dollarization and significant inflation pass-through.
So it's about recognizing those vulnerabilities and tailoring the policy, not just importing a one-size-fits-all solution.
Exactly. It's about smart policy design based on evidence and context.
What a journey through this research. We've really unpacked the intricate and sometimes paradoxical links between exchange rate regimes and banking crises. The big takeaway seems to be this stark trade-off. Fixed exchange rates can act as a shield, reducing the likelihood of a crisis, particularly in developing nations. But if a crisis breaks through that shield, the fixed rate can become a heavy anchor, potentially deepening the real economic damage and creating risky moral hazard incentives along the way.
And crucially, the choice of regime doesn't seem to dictate the fiscal cost of the cleanup or how long the crisis lasts. Those depend more on pre-crisis conditions and crisis management.
It really highlights the delicate balancing act policymakers face, especially in developing economies where the vulnerabilities are often starker. It's a powerful reminder that these big economic policy choices are rarely simple, with clear winners and losers.
Absolutely. So perhaps a final thought for you, the listener, to chew on. Given these really complex trade-offs where one policy might lower the chance of disaster but increase its severity if it happens, while also potentially encouraging risky behavior, how should countries think about designing their financial systems? How might you try to capture the stability benefits that a fixed regime seems to offer, while actively working to mitigate those potential high real costs and the moral hazard risks that come with it? What stands out to you as the most critical tension, the most difficult balance a government has to strike when choosing how to manage its currency?